Okay, folks, it's time, and you guys cut it close. I was still seeing projects come in like 2 minutes ago. So uh, the timestamp, hopefully, when you submitted the project, was before 12:30 New York time. So I'm glad you're here, and we're going to talk about the case. I know you're probably sick and tired of Google and electric cars, but I might as well get it while it's still fresh. Now, as I go through this presentation, I want you to remember one thing, which is I'm going to present you my numbers, but these are not the numbers. There's enough give on this case that there can be disagreement, different assumptions, at least, not even disagreements, different assumptions on some things that can lead to different numbers. So I don't want you to freak out when you see a different cost of capital or a different or a different cash flow in year one. There are some things which I will point to where you say, I wish we hadn't done that. No, we did that and that was wrong. But think of this as a process, because much of what we're going to talk about in this case is something that underlies almost everything we do when we do valuation, when we do corporate finance. So I gave you most of the facts of the case, right? I mean, essentially, I gave you the key details on market share and prices and costs. So I'm going to start by giving you what I found on the case. And again, I want to emphasize, if your numbers are different, don't freak out. It's not the end of the world. So when I ground through the numbers, and it's entirely possible, the first thing to remember is working with time. I mean, many of you realize this as you work through the case. It's not real, right? Things don't happen at a point in time. They happen across time. You don't have cash flows at the end of year one. You have cash flows during the course of the year. That's why I tried to be as specific as I could be about timing. I said, this is now it's right now, year one, year two. But when you work in discrete time, you act like everything happens on one day, right? December 31st of the year. That's not realistic, but it does make it much easier to kind of work with the numbers. Now, there are some people who use, mid-year conventions, and I don't think it makes much of a difference. If your project needs to go to a mid-year convention to become a good project, it's probably not a good project to begin with. So with that background, let me give you what I found when I looked at the case. On a standalone basis, this project looks like it's a value-adding project, less so in the finite life case than in the longer life case. In fact, the average return on capital I got in the finite life case was 10.67%, if I didn't count synergy, and 11.62% with synergy, both of which were higher than the cost of capital that I estimate. So I'll go through the process of how I got the cost of capital, and you can check your numbers if you have them in front of you to see where we disagree. The net present value that I got for the GCar it should be the cost of capital of 7.84%, not 8.01%, was $1.744 billion. I just put this up actually online, so you should be able to download the slides after class. Okay? And if I used a longer life, in my case, I used an infinite life, the value that I got was much higher. Now, you might say that's obvious, but some of the things I'm going to point to today will tell you when a project's value will increase as you extend the life, when it will not. The IRR I got, basically, and I'll go through the process of IRR, a little messier than doing the NPV, but they both backed up what I found with the NPV. All of the numbers in the case were based on the assumption that Google would deliver the market share that I thought they would, and that they would preserve pricing power. That shows up in the price per car. So based on the numbers, it looks like Google should enter the electric car market. So having said that, let's talk about the details. Let's start with cost of capital. Remember the lesson we went through over and over again with every single project analysis? We said the cost of capital should reflect the risk of the project, not the risk of the entity looking at the project. So by now, when you look at a project, you already know that you need to think about what's the risk in this project. And this is a clear deviation from Google's history, right? Google's history is as an online advertising company with a little bit of software, a little bit of devices, but this is the automobile business. And I gave you the betas of automobile companies, their debt to equity ratios, the cash, and that's where I started. I said, this is a project in the automobile business. So I'm going to come up with the betas of companies in the automobile business. So I use the medians. And remember why we use medians. It's not a financial rationale. It's to keep the outliers from running away with our analysis. So I used the median beta and the median debt to equity ratio to come up with an unlevered beta. And I cleaned up for cash. And the unlevered beta that I came up with for the automobile business was about 1.04. Now, if you used averages, your answers might have been a little different, and I'm perfectly okay with that. So that's what I meant about a little bit of wiggle room. I didn't ask you to use the median specifically, so there might be a little bit of differences depending on how you computed your industry average. That is going to become the unlevered beta that I use for the GCar project because it's an automobile project. To get the levered beta, I had to get a debt to equity ratio for Google because I did specify in the case that Google would be using the same debt to equity ratio for this project as they used as a company. And to get the debt to equity ratio, I started with the market value of equity, which I gave in the case. Some of you use an updated value, which is perfectly okay. But that will be a shifting number. It's 1.3 trillion. And for the market value of debt, I was trying to be helpful, though for some of you, I actually created more work. I gave you the market value of the interest-bearing debt. I said it's 5 billion. You don't have to go through book debt and compute the market value because it's really not worth the effort. But I said I haven't counted the leases. So the present value of leases that I got was about 13.85 billion. Again, there can be a little variation around that depending on what you assumed about the lump sum after year 5, because I gave you the commitments for the next 5 years and beyond. I used 2 years beyond year 5. That gave me 13.85. So the total market value of debt I got was 18.85 billion. As a debt ratio, that's 1.43%. Debt to equity, 1. So Google has very little debt. In fact, I heard from quite a few of you asking whether you've done something wrong because you were getting such a low debt ratio. You know what? That's not unusual for a technology firm, having a low debt ratio. In fact, many of them have no debt at all other than lease commitments. So Google doesn't have very much debt. I use that debt ratio to compute the numbers for this project. So I use the debt to equity ratio to come up with a levered beta. And that levered beta in conjunction with the equity risk premium. And the equity risk premium I use is not Google's equity risk premium. It's the equity risk premium based on where Google plans to sell these cars. So I gave you the regional breakdown, 6.11%. So there's my cost of equity. For the cost of capital, I bring in the cost of debt because I gave you the default spread, 0.6%, 25% tax rate, 7.84% cost of capital. Any questions on computing the cost of capital for this project? You're saying, why do you show us the Bloomberg betas for Google? Sometimes you got to be able to deal with distractions. Those Bloomberg betas I showed you were there, and you will always get them for any company, but they're completely irrelevant when it comes to coming up with the cost of capital for this specific project. Now, what I'm going to do next is going to freak out a few of you because I'm sure most of you didn't do this. There are two sets of cash flows on this project, right? One is to the GCar, for which I'm going to use as cost of capital, but there's a side benefit. Remember what the side benefit was? Josh, do you remember what the side benefits were from this project?
Do I remember right there at the time?
No, I'm sorry, what? You don't remember? No.
You did. Sorry, I couldn't hear you.
What do you remember there were side benefits from this project? Do you remember what the side benefits were?
For Google?
Yeah, from taking the GCar.
I don't remember specifically what we talked about, but I mean, it just makes more sense from staying competitive, and because I think the idea was that they were thinking that ad revenue business was shrinking, so they wanted to grow into somewhere.
Right, but I gave you a very specific side benefit to this particular project. Does anybody remember what it was?
Yeah, it was the additional sales in Google devices, screens.
Google devices, right? 500 million, a tiny amount, 500 million. The cash flows from that accrue to the devices business. Do you see where I'm going? The cost of capital I should be using to discount those cash flows should be the device's cost of capital. So for the device, that's why I gave you the breakdown of businesses. Now, to relieve you of any anxiety you feel at this moment, I'm taking no points off for not doing this. So, I'll give you the actual grade template. So this is a freebie. I'm going to concede it to you because in this project, it's not a big enough number that I want to make this the hill I'm going to die on. But when you get side benefits on a project accruing to a different business, the discount rate you use on those side benefits should reflect the risk of it. Now, so for those of you who brought in those side benefits into your total cash flows and used the 7.84 or whatever your overall GCar cost of capital is, you're probably discounting those cash flows at too low a discount rate. So to get the cost of capital for the side benefits, I started with a levered beta for Google devices and built up to a cost of capital of 10.57%. So you're going to see both those costs of capital floating around as we go through. So I asked you for your numbers.
Professor, can I ask a quick question on the last slide? Sorry.
Sure.
The cost of debt that you're using here looks like the pre-tax cost of debt, while in the Disney example, I think we use the after-tax cost of debt.
No, I do multiply by 1 minus t, right?
Oh, I'm sorry. I missed that. Okay.
So it is always the after.
Okay, perfect. Thanks.
So you send me your numbers. So I'll give you the good news. We're a lot of bunching around 7.84%. There were a couple of groups which had cost of capital of more than 10%. I'm not sure what went on. So if you were one of those groups, don't freak out. Again, I'm not sitting there saying, what the heck did you do? But you might want to re-examine. It's too late to go back and fix your case right now. But think about what you might have done that gave you, and there were a couple of groups, the cost of capital was 5.5%. So, I mean, I can understand 7.7, maybe even 7.9% because there's a little bit of variation, but we're in the 10%, 9.5% range, or 5.5, or 6% range. Something is going on in your cost of capital that shouldn't be. Any questions about the cost? Because if you did something different, something very creative, this might be the time you want to air it out, even if you don't want to kind of expose it to the public scrutiny. If you did some weighted average, or, I mean, there's something that was done to the betas probably that gave you this really high cost of capital or really low cost of capital. So if you did something different and you want to check to see whether that would fly, I mean, any questions on cost of capital part?
Yeah, I have one question.
Go ahead.
We use the unlevered beta instead of the pure play beta to get to our levered beta. So the 0.9 instead of the 1.04.
Yeah. So what is the problem with doing that? Why is the beta for automobile companies low? Because they tend to have a lot of cash, 13.5% cash. So you use that lower beta. Remember what you're discounting. You're discounting the pure cash flows in this project, right? Operating income, free cash. So the problem with using the beta not cleaned up for cash is you're essentially acting as if this project is carrying 13.54% cash, and it's not, because you're extracting the cash flows out each year. That's why you always try to go to a pure play beta if you have the data on how much companies have as cash balances. Any other questions?
I have a question.
Go ahead.
So the present value of the leases, how did we come up with $13 million?
What did you get?
I mean, we got, after year 6, we assumed that the lease payments are annuities, that is going to continue throughout the whole
For
firm.
how
So
many?
we got,
I did too, but over how many years?
we just used the PV of annuity formula.
But to use a PV of annuity, you got to specify how many years of annuity, right? So you took the lump sum in year 6, and what do you do? How many years did you spread it out over?
I have to check that. Okay, I think it's a miscalculation on our end then.
No, but that shouldn't make that much of a difference. So if you spread it out over 4 years, you get 13.6 billion. If you took it all in year 6, you'll get 14. There's not that much room to vary. So between 13 and 14 billion, it's just differences in assumptions about timing. But if you got something like 6 billion or 30 billion, something clearly went off.
Yeah, we got 30 billion.
Which is actually more than the sum of the nominal amount. So there's some present value function that got thrown off, right?
Yeah. Oh, all right.
I have a question. So when we are calculating cost of capital for Google devices,
Yeah.
in the cost of equity, do we take the equity risk premium of the mature markets, or do we take the weighted equity risk premium? The 10.7%.
Now, when you say weight, you're saying, the only place, the equity risk premium I used was the 6.11% coming from where you were selling the cars. I'm assuming that where you're selling the devices reflects where you sell the cars. So I'm not sure what you mean about, what are the, I don't even know what the alternatives would be, right? You don't want to look at Google's breakdown of revenues because it's irrelevant. These are devices and software you're selling with the cars. And if you're selling 20% of your car, so that's why I'm using the 6.11% equity risk premium. I don't even think I gave you the information to compute Google's equity risk premium, did I? I didn't give you their geographical breakdown. So you really had no choice because you really didn't even know what the equity risk for Google is because Google has revenues in the rest of the world as well. So it's this or nothing. In fact, on this one, I didn't even think there was really an alternative but to go with the 6.11%.
We assume that in the mature markets, that's where the side benefits will be.
That's fine. That's the kind of assumption where I think you can get away with it. You'd have to tell a little convoluted story to back it up, saying we sell most of our device and software in the US, or even if we sell cars overseas, it's going to be. So I don't think it makes so use 4.72% of 6.11%. It's going to give you a lower cost of equity. But you can't do that for the GCar. Right? For that, you have to use the 6.11%. Any other questions?
Can I ask a question about the beta calculation? Sorry. So we ended up using the whole auto comps just given the number, but if we did look at the smaller subset of luxury or premium brands, the beta was much higher, even though there were only about 7 or 8 of those.
And that'd be perfectly okay. That's what I meant about degrees of choice here, right? Because you can say, look, this is more of it's an expensive car. I don't want to compare it to Volkswagen. I want to compare it to more luxury automobiles. It'll give you a smaller subset, but you have enough companies there that you can just slice and dice maybe 12 companies out of that and use that to get your beta. So that's perfectly okay.
Okay, thanks.
Ashwin?
Professor, sorry if I missed this. How do we get the beta for Google devices to calculate the cost of equity?
Oh, it was given. It was given in that exhibit, which had your 2 regression beta pages.
Okay, all right, thank you.
At the bottom of that page, it was actually I broke down Google's businesses, and I gave you the beta for each business.
Got it, thank you.
Now I'll give you my projections, and I don't want to spend too much time on this page because this page just takes the information I gave in the case and converts into numbers. So I've actually computed 2 measures of operating income. One is a pure accounting operating income, where I do what accountants do. What do accountants do? They allocate, they do dances. So I do whatever they do. So the difference between the operating income and the incremental operating income is in that G&A expense. Where in the first one, I use the allocated G&A because that's what accountants do. And the second one, I say, why am I even looking at the allocated amount? It has nothing to do with the project. I look at only the incremental G&A. So if you look at my operating income, it starts with the loss and it works through. I am assuming that in year 1, when they lose money, that they will get tax savings elsewhere, which makes sense. Google is a money-making company. They will find a way to get the tax savings almost instantaneously. So this pattern of starting with losses going to profits is a pretty standard one. So I did it for the next 10 years because that's what the information gave me to do the next 10 years. Okay. So the first question that I asked you after the cost of capital is tell me what your return on capital is. To get return on capital, I'm going to take that after-tax operating income. Oh, incidentally, am I telling you that there are no interest expenses on this project? Because it looks like I'm not netting interest expense out. So why am I ignoring interest expenses? I want to get this nailed down because this, I think, is a central theme of investment analysis, is why am I ignoring interest expenses?
I think you ignore interest expenses because they give tax benefits. And actually, if we ignore tax benefits, we definitely will not overestimate the final operating income.
Well, so you're saying I'm doing it to be conservative?
No, I think you just gave us a chance to make an assumption, to take taxes or not to take taxes, to overestimate or not overestimate the net operating income.
That's a pretty dicey thing to do, right? Because the tax savings is the tax savings. You can't ignore them. I mean, go back when you think about the Disney theme park that I did and the Vale iron ore mine. In the Disney theme park, there were no interest expenses. Remember, I did operating income, came up with cash flow. On the Vale iron ore mine, I did include interest expense. I did net out interest expense, and I even netted out debt repayments. Then what discount rate did I use? For the Disney theme park, I used the cost of capital as the discount rate. But when I did the Vale iron ore mine, I used cost of equity. You could have done this with interest expenses. It would have been perfectly okay, but the cash flow you would get then would be a cash flow to equity, not the cash flow to the firm. And if you get cash flows to equity, the discount rate you should be using not the cost of capital, but the cost of equity. So if you did net out interest expenses when you did your analysis, it's a tiny number. It's really not going to alter your decision, but it's a fundamental problem because if you've netted out interest expenses, the income you get is net income. It's an equity income. You'd be computing a return on equity based on book equity. So it's consistency that's driving it here. I'm doing everything from the perspective of the entire company. And that's why there's no interest expense when I do my calculations. Now, to get from that after-tax operating income to a return on capital, I need a measure of how much capital Google is going to invest in this project, right? So here's what I did. I started with the book value fixed assets. Where does that come from? It comes from your capital expenditures up front and any additional capex. And in this case, you can see it starts at 27 billion and then I depreciate it over time. I also give you a working capital requirement, right, which is a function of cost of goods sold. That becomes part of my invested capital as well. And I'm going to talk a little bit about this capacity expansion that I put myself into because I take this project. That becomes part of my invested capital. Incidentally, if you didn't include that in your invested capital, not a big deal. It's not going to make a huge difference in your return on capital. So I've got after-tax operating income, multiple measures, invested capital. I've computed return on invested capital every year for the next 10 years. And the pattern, again, shouldn't surprise you. It starts negative, becomes increasingly positive as you move through time. Now, one of the problems with just taking a simple average of the returns on capital is you get very, very high returns on capital, especially towards the end of your life, it's going to push up your average. So I use a little trick, and again, I'm not looking for you to have used this. Whenever I have projects where you have a shifting base, the invested capital is shifting, I just aggregate all the numbers, aggregate earnings, aggregate investors. So this is a total amount across the 10 years. And that last column is, I think, a much better indicator of what you're actually making on this project. You're making about 11.62% return on invested capital with synergy and about 10.67% with no synergy. What do I compare it to? I compare it to the 7 point. So if you look at with synergy, I'm beating the return on capital, but without synergy, I'm having a really tough time getting up to it. So with return on capital, the project looks kind of marginal, right? Until you bring in the synergy, there's really no additional payoff. But on return on capital, there are choices you made that affect your return on capital. For instance, I gave you some leeway on that capacity expansion. If you did make it, I didn't tell you how to depreciate it. Some of you might have depreciated over 10, some might have depreciated over 20, some might have expensed it. Oh, incidentally, if you're wondering what happened to the 5 billion they've already spent, you know why it's not part of my invested capital? Because I expensed it. When you expense something, it doesn't become part of your capital. It doesn't become part of book value. So it didn't even enter the equation. Right? So that's good because you don't want it to anyway. But when it comes to return on capital, I wasn't surprised to see the wide variations in return on capital because it depends on what you include invested capital, how you compute operating income. And I'm computing everything based on marginal, with the marginal tax rate as my tax rate. And what you found reflected those divergences. Notice how the distribution goes. There's no peak. Unlike the cost of capital, where we kind of agreed on 7.5% to 8%. Here, the numbers are all over the place. For some, maybe the returns on capital were more than 20%, some it was less than 5%. And the key I think is going to be what you included in invested capital, because those of you who got returns on capital above 20%, you are depreciating your capital almost down to zero. I checked a few of your cases. And if that happens, your return on capital in year 10 is going to be like 120, 130%, which was pushing up your averaging. So the way you compute the average can affect what you reported as overall return on capital.
Professor?
Any questions on the accounting earnings and return on capital?
Yeah, so if we did count that 5 billion as capital invested, is that a mistake or that's just an assumption that we can make?
Let me ask you a question. Did you base your decision on return on capital?
No.
You know what I'm going to say? If you didn't base your decision on it, I'm going to allow a lot of sloppiness in return on capital, to be quite honest, because and that's something to keep in mind when you're not basing your decision on a particular metric. I understand you want to move to the metric you're going to count. So counting the 5 billion, not even forgetting to include working capital, which is something I don't think you should do. I'm going to let it slip. So on return on capital, I'm going to cut an incredible amount of leeway because you're not basing your decision on it. It's an accounting number. Yeah.
I guess my question is more in our overall model, is it a mistake to have counted that 5 billion as a capital investment? Nothing just about return on capital.
It is directly in contradiction with the facts on the case, because the case said it is expense. So when something is expense, you usually don't capitalize it. If you capitalize it, you made your life just a lot more difficult than it had to be, right? Because you capitalize something, you had to depreciate it. So you'd have to take that depreciation. I was trying to make your life simpler, to be quite honest, by making it an expensed item. So if you chose to make it a complication and clean up for it, I just think you added layers of work you didn't have to, but it's not going to change your decision, because even if you capitalized it and depreciated, it's non-incremental. You'd have taken it out anyway. So the net effect on your cash flow should be zero. But I think anytime something is expense, you should not be counting it as part of capital investment. You're saying, but you did it differently in the Disney theme park. In the Disney theme park, I capitalized that expense. That's why I depreciated it there. So wording does matter here. The expensing basically means you can ignore it when you do accounting earnings and returns on capital. Any other questions on return on capital? I don't think any of you, yeah, go ahead.
Yeah, I have one on how you got your revenue. I think we differed in how many cars were sold in the first year. Because
I think 7.8 million is, the facts of the case, I think 7.8 million is in fact the right answer. So if you got a number different than that, so what did you get as revenues in year one? Are your revenues different? Let me ask you a different question. Are your revenues different in every year or just year one?
It's a little off in every year, but it's probably because of how you started, where you considered the 5 million automobiles, the timing of that.
Yeah. Okay, so that can be off because I tried to be specific about what the starting point was. So if you made that year one, instead of the base year, you're going to start with a lower revenue. It'll be lower all the way through. That's, again, that's one of those things where I'll cut you some slack on that, because it's a timing issue, right? Because then you'll be off by basically the growth rate in the car market by 1 year, okay? Which will mean that all your revenues will be lower than mine every single year.
Mine were actually a little higher. That's because I assumed 5 million was the year just ended. So
okay, so you got the extra. Okay, so that's a growth. So again, that's not a big deal, but again, that's why timing matters. And that's why if this were a real project, you'd ask people, and then they say the estimated market size is, the first question you're going to ask is that last year's number or is that next year's number? Because that's going to make a big difference in how you build your revenues and the number of cars you will sell.
Also, one more question, sorry.
Yeah.
On depreciation on the previous page.
Mm-hmm.
So at year 4, we're building a new facility, but that adds to the depreciation. Aren't we expensing it? I don't quite get it.
Did you expense it? I didn't give you any. I mean,
Yeah,
basically,
okay, so we expensed it. Okay, that's fine.
Yeah. Be careful what you can expense. You probably, the IRS probably not let you expense something like that. So again, if you expensed it, it'll all be in that year. There'll be no depreciation to worry about. I capitalized it, which meant that I had to depreciate it as well. So the case didn't specify what, so if you expensed it, no, I'm going to let that be your assumption. It'll give you different cash flows as a consequence. Now let's look at the first thing I asked you to do. I asked you to compute the net present value over a 10-year life, right? Now, when you look at the 10-year life, I've given you all the numbers, but there is this additional factor I throw in, which is by taking this GCar, Google is going to be using up some existing capacity. And given that the GCar will use up that capacity, you'll run out of capacity, I think in year 4 was what I projected. Again, you could be off by a year depending on how you started, but with the GCar, you'd run out of capacity in year 4. And I specifically said, when you run out of capacity, you need to build new capacity. And I gave you the cost, right? 5 billion growing at the inflation rate. So you're going to have to spend 5.15 billion. And I made the investment in year 3 because you don't want to run out of capacity in year 4 and build instantaneously. So my investment shows up at the end of year 3 because the capacity is going to run out in year 4. So 5.15 billion becomes this negative cash flow that I show in year 3. Now I capitalize the 5.15 billion. So I don't get a tax saving right away, but I get depreciation, and I used a 20-year depreciation life. Again, we can, you might have used 10, you might have used 5. So I spend more money earlier. But I have to finish that thought. That's what happens if I take the GCar. Remember I said with incremental cash flows, you need to ask 2 questions. What will happen if I take the investment? What will happen if I don't take the investment? I've answered the first question. By taking the GCar, I run out of capacity in year 4. Let me ask the follow-up question. What will happen if I don't take the GCar? I'll continue to use the capacity with my existing products, but they're growing, right? And with their growth rate, you're going to run out of capacity anyway, with or without this project. In fact, you run out of capacity, I think, in year 9. So basically, all this project is doing is it's moving an investment you'd have made in year 9 into year 4. You see where I'm going? If you're going to show the 5.15 billion as a cost in year 3, to be internally consistent, you now have to show the 5.5 billion 5.4 billion you'd have invested in year 8 because you'd have run out of capacity anyway. So I'm going to show you a minus 5,151 in year 3, but you're also going to see a plus 5,000. You're saying, what the heck is that? That's a savings I'm getting because I don't have to build that capacity. The working capital is invested at the start of the year, so you're going to see it show up at the end of the previous year. So here's what my incremental cash flows look like. I start with the incremental operating income, and because it's already incremental, I don't have to do the G&A adjustment, so I just went directly to the incremental. I add back the depreciation. I subtract the CapEx, but I also subtract out the 5.15 billion in year 3 for the new capacity I'm building, and there's the savings in year 8. The change in working capital is there. And you're saying, what are those red numbers at the end? At the end of year 10, what do I do in this case? I just liquidate the project. I get the book value of my fixed capacity, which is 2 billion. But I also get all my working capital back, which is the sum of all the investments. That's about 4.76 billion. If you forget that, implicitly, here's what you're saying. At the end of year 10, here's what you're going to do. You're going to shut the project down. You're going to open up the storerooms and let people take the GCars they want and drive it away for free. That's effectively what you're doing if you're ignoring working capital at the end of year 10. So those are my incremental cash flows in the finite life case. Any questions?
Professor, I have a general case question, not specifically for this. That $27 billion CapEx, based on the 22 billion in cash that Google currently has, isn't there, in theory, they can't actually afford to do that in year 0, so they would need to either issue new debt or new equity in order to raise more capital?
Does it matter though? It's already in your cost. Isn't that what a cost of capital captures? I mean, when you do
Okay.
an initial investment, you don't have to have the cash on hand, right? So when you have to, whether you have to raise the capital or use cash, you put the same criteria. What do I need to make on this investment to break even? So the cost of capital essentially conveys the fact that even if they had no cash, they'd have to go out and raise equity and debt. They'd raise about 98.5% from equity, 1.5% from debt. You're bringing it through the cost of capital.
Okay, and any interests or any interest payments or anything on that would not factor in because we've already covered it.
But be very clear about that. The reason it's not factored in is because I'm doing cash flows to the firm. If I did cash flows to equity, then I'd focus on just the equity portion of my upfront investment.
Okay, thanks.
Sushant?
So I think you would probably go this next slide, but I just want to ask, so the opportunity cost of capital, which is coming in year 3, that's a part of GCar business, but the one that is negative in year 8, that would have been, if GCar wasn't there, that would have been
all incremental cash flows. Don't think of a project as a standalone business. It's part of a much bigger company. So when we do incremental cash flows in a project, those incremental cash flows are to the company. So it's basically Google saying, what are the incremental effects of taking this project? So we don't actually attach a name to a distribution system and say, this is the GCar distribution system, this is the Google distribution system. It's all part of the company. So from that perspective, attaching a name to an investment actually can lead you down the wrong path because you're missing the cash flows that the company faces. Because projects don't have money. Companies are the ones that come up with the money.
So I agree with that. So my only question was that would the discounting for the negative figure there in year 8 would be as according to the Google?
Yeah, if you want, that's it. Yeah, if you wanted to slice and dice, you can say maybe I should be using the Google score. And if you did that, that's perfectly okay. That I think is good logic to think. In this case, it wouldn't make much of a difference, the present value effect. But I think that's a good point. Maybe we should be using the company's cost of capital for all distribution systems, because in a sense, even the investment in year 3, it's not just cars that are going to be stored in there, right? It could be devices, it could be whatever else. So from that perspective, you're saying maybe this opportunity cost of capacity should be a separate line item with a Google cost of capital attached to it. House?
Yeah, Professor, why is there a change in working capital in year 0?
There is no year 0. 0 is a point in time, right? So what do we say about working capital? The investment has to be made at the start of the year, right? Mm-hmm. The start of 0 is right now, right? If you think about year as a time zone, the next 365 days, right? Normal timing is everything happens on day 365, but if it happens at the start of the year, it's happening on day 1, which is where we are right now. So when you look at the working capital needs, it's always going to be 1 year ahead of when you need it, because you're making the investment at the start of each year rather than waiting to do it at the end of the year. So year 0 is actually a misnomer. It's time 0, which is right now. You're making the investment right now to cover your first year's needs. You make the investment at the start of the second year to cover the second year's needs. So every working capital number that you see there will be staggered by a year from when you calculate it. So because if you put the 568 in your, yeah, go ahead.
Yes, no, I'm just thinking because, so in terms of the investment being made, since working capital is the percentage of the costs, which will not happen until year 1. I hope I'm not wrong about that. So
but in the real, what you're doing is you're buying this, let's say what you need to make a car is you need steel, you need tires, you need, what you're doing is you're buying all of those, putting them in your inventory at the start of the year, rather than go by it. This is, I think, and that's why I said when you make time this discrete system, you're going to face this problem, because in the real world, you'd buy inventory in the first month, the second month, the third month, you would not be stocking it up. But because I'm making you pick, I'm asking you, when in the year are you going to buy? If it's earlier in the year, I'm going to move you to the start of the year. If it's later in the year, I'm going to move you to the end of the year. So things like receivables, you might say it's only when I sell the car, but things like inventory, you might have to buy those first before you start making the cars. So that's where the timing comes in. Again, it's not a huge deal. I'm not punishing anybody for showing it in year one. I'm just saying, think about timing. Sometimes sometimes it can make a difference. Karthik?
Professor, so regarding the last year's working capital where we sell off everything. So if it's a 10-year scenario where we are selling stuff off, that would make sense. But if we are doing the infinite life scenario, we are still considering only the 10 years. And that throws the entire calculation out of whack.
Wait, back up. What do you mean? So this is not the longer life. You have to make your choice. This is not, I'm just arbitrarily stopping in year 10. I'm asking you to run this project as if it has a 10-year life.
No, so my question.
Yeah, go ahead.
My question is that even in the infinite life, we run the 10-year analysis and then based off of that, we do
that's not true. You don't run a 10-year analysis. You do a 10-year cash flow, but the analysis runs forever. The fact that you use the terminal value equation is just a convenience, right? If you think about it, you're actually doing cash flows forever.
Right.
So you stop your cash flows in year 10, but you're not stopping your analysis in year 10. You're using that perpetual growth equation to make your cash flow calculation more manageable by doing the terminal value.
No, I'll stop off this. Maybe I'm not listening to this right, but I understand the terminal value thing that we take a growing perpetuity in a sense.
No, but why are we talking about this? This is liquidation value. This is the 10-year life. We're not talking about this as a subset of the longer life. This is running the project for 10 years, shutting it down after year 10. So this is a very different scenario. In fact, I'm going to draw attention to that than saying I'm going to run the project as if it has a longer life. Here you're running the project for 10 years, you're shutting it down, you're liquidating it, you're getting your salvage value, and then you move on to the next business.
Right. Okay. Thanks.
Al?
Hi, Professor. I was just curious, do you factor in capital maintenance expense at all? Which is what I did, increase my depreciation.
Let me ask you a question. Did you have capital maintenance in year 10?
Yes.
And 9?
Yes.
Why would you? What did I just say in the previous thing? I'm running this project as if it has a 10-year life. Why the heck would I be investing, maintaining capital at the end of year 10 if I'm planning to shut the project down?
Well, you did ask us to calculate NPV for longer life, no?
No, not in this one. This is the finite life. I haven't gone to the longer life yet. So when you look at the longer life, that's a legitimate question to ask. In the finite life case, you got to behave as if it's a finite life project. It's not just the first 10 years of the longer life project. This is a finite life analysis, a very different way of managing this project than acting as if it is a longer life. Carlos?
Yeah, I had a question about the facility build, going back to the previous slide.
Mm-hmm.
If you, I guess one of the approach we ended up taking was to CapEx, just treat it like capital expenditure in year 3, but to use the net present value difference in cost.
Yeah, you can do that.
Year 3 and year 8.
That's perfectly okay.
So,
did everybody get what Carlos was saying? You can take the net present value difference between 5.15 and 5.4 and show it as the amount in year 3. You'll get exactly the same net present value.
But then your depreciation between years 4 and 8 would be the 5.15.
Yeah, that's what you miss when you do the present value effect, right? Because then you miss the fact that you get depreciation for those 4 years in advance. So you miss that layer. But you know what? I can live with. I can live with that because you're pretty close to the final answer, even though you're missing the depreciation component.
Yeah, that's where we got a little confused with how to account for the depreciation with the difference.
Leander.
No? I happen to have the same question with Carlos.
Okay. So Shantanal, you have more questions or your hands are up from before? Okay. Now, of course, the side benefits, as I said, come from those incremental revenues and devices. And I try to make your life simpler by giving you the after-tax margins on revenues, because all you need to do is multiply the after-tax margin by the revenues. You basically got the additional cash flow, nothing more to do. If I hadn't given the margins, then it would have been more difficult. You'd have to then figure out what the margins were and devices, apply it here. But basically, that's the additional cash flow that's the side benefit you're getting from this project, from selling more devices and software. So here's what my finite life NPV looks like. And I want to emphasize, finite life just doesn't mean you take the first 10 years or whatever you've done and make it. Finite life means starting in day one, I'm running this project expecting it to end after year 10. That's why I'm not putting in any money in capital maintenance. It's all going to get wrapped up in year 10. Why keep everything looking sprightly and new when I know it's all going to get liquidated? The net present value that I get with just the GCar cash flows is 1.744, and that's where I use the cost of capital for the GCar. And for the devices, I use the higher cost of capital, the device cost of capital. You add those two numbers up, you get the total net present value for this project of close to $3 billion. That's if I run it as a 10-year project. Any questions? So when I looked at your projects, this is a very strange distribution, right? It's like you have you have peaks on both sides. You had almost 10 groups. I think 9 groups had negative net present values of 2 billion, 2.5 billion, 3 billion. And I'll make a guess on why. Now, who is it? Was it Al who mentioned that he had capital? Who was it that asked me about capital maintenance? Was that you, Al?
Yes.
Okay. If you put in capital maintenance and you shut the project down after 10 years, what do you think you're going to do to this project? You're going to kill it. You're going to kill it because you're making it invest as if it's going to be a forever project, and then saying at the end of it, and surprise, we're shutting everything down, let's get salvage value. My guess is the huge negative net present values come from people who put in huge capital maintenance into their finite life cases. As for the huge positive net present value, I have no idea. Maybe you forgot an expense, I don't know, something got, because something is clearly different from my computation. Now let's get to the longer life case. Incidentally, I don't think I asked you to use an infinite life. I just said longer life, right? In the case, didn't say? So longer life doesn't mean you have to go forever. You could just add an extra 15 years, another 20 years, another 30 years. So I left that choice. My guess is most of you went with the perpetual life simply because it makes your terminal value calculation easier. But here's the difference. Now I'm running the project very differently. Why? Because on day one, here's what you tell me. We're going to keep this project going, not just for the next 10 years, forever. You need to make sure that happens. So here's what I'm doing. Remember, every year I get depreciation back. Think of depreciation as depletion of capital, basically. I mean, the analogy I would offer is depreciation is like exercise. You're burning through calories. Capital expenditure is like eating food, calories. So if you don't keep eating, you keep exercising, you're going to get anorexic and you're going to essentially have some kind of serious problem sooner or later. There's nothing coming in. Here, because I'm saying, look, you've got to stay at your fighting weight for the really long term. Every year, I put money back. Because in this case, I'm following Al's advice, which is this is a longer life project. I need to have capital maintenance. And the question is how much? And here I'm willing to accept different assumptions, but remember, if you put in less than your depreciation into capital maintenance, your capital invested is shrinking. Basically, you're not doing enough to maintain your factory. So one of the assumptions that people in valuation make to maintain a company is assume that capital maintenance equates to depreciation. You're keeping your invested capital stable. I actually set it at above depreciation because there's inflation. With inflation, it costs you more to replace what is being depreciated. So I said it, the inflation rate was 1%. It's not a huge deal, but basically I brought in capital maintenance. And at the end of year 10, I can no longer salvage working capital because I've got to keep the project going. I computed terminal value. So here's what my numbers now look like. And now you will notice that my capital expenditure, in addition to my 27 billion, I have capital maintenance every year. Running my project long-term is a trade-off. I get this bigger terminal value, but to get the terminal value, I've got to reinvest more every year as I keep this project going. My bottom line cash flows, My initial investment is the same under both cases, but I actually get less cash flow every year for the next 10 years. Why? Because I have the capital maintenance, but a much bigger end value in the terminal value. I use the 1% inflation rate as my growth rate in perpetuity, and I'll tell you why I capped it at 1% in a second. But I assume that the cash flow in year 11, which I estimated to be 4.75 billion, would grow at 1% a year forever with my 7.84% cost of capital, and I get 69.4 billion as my terminal value. So just to show you the effect of moving from finite to a longer life, is those are my finite cash flows, those are my longer life cash flows. As I decide to shift off, the trade-off looks as follows. I accept lower cash flows every year for the next 10 years. That's the capital maintenance kicking in. But in return, I get a much higher terminal value. In this project, now I want to emphasize in this project, extending the life increases net present value. But in most projects, when you bring in capital maintenance, and you bring in a terminal value, extending the life won't increase the value of the project, it'll actually decrease. And that's why most projects are finite life. Because if you could just replace salvage value with terminal value, every project will last forever. You would never shut a project down. And here I shut the project down because I would not shut the project down because the terminal value more than makes up for the cash flows. So when I did the net present value for the longer life case, I had the lower cash flows for the next 10 years, bigger terminal value. The net effect is it improves my net present value fairly substantially. But here's what you're going to see. If you have the same cash flows, and that's one of the things I'm going to check on your case, is I'm going to look at your 10-year cash flows in your finite life case, your 10-year cash flows in your longer life case. If those cash flows are the same in both cases, you're being internally inconsistent because you're in one case, you're ending with a salvage value. In the other case, you're ending with a terminal value. And those are two very different sets of assumptions. So as a general rule, and this is nothing to do with the project, if you end a project, you can get away with no or very low capital maintenance. Why? Because you're a finite life project. If you give the project an infinite life and you put in a zero growth rate in perpetuity, which you're allowed to do, then you can set capital maintenance equal to depreciation. You just have to maintain invested capital. If you put growth equal to inflation, then your capital maintenance should be higher than the depreciation by usually the inflation rate. But if you make the growth rate greater than the inflation rate, then you have a real problem on your hands. Do you see why? If I let those cash flows after year 10 grow at 1.5% a year, I'm going to run out of capacity. I'll have to build new factories. And unless you're setting that money aside, you can't just take the year 11 cash flows and kind of let them flow through. On the project itself, clearly many of you found huge net present values. And probably because you either had no capital maintenance and just took a year 11 cash flow and just grew it out at 1% a year forever, in which case you're going to get this magically huge jump, or because you have the same capital maintenance in both cases. Any questions in the longer life case? You look shell-shocked.
Professor,
yeah.
I wanted to ask, you took the capex again at the end of year 10, and that's kind of repeating every 10 years.
It's no, it's not repeat. It's repeating every year because remember your terminal value, cash flow, everything you do in that cash flow happens every year after that. So if you go back and look at my year 11, I'm sorry, let me go back to the previous page. There's a year 11 here. I compute the year 11. Whatever I'm doing in year 11, I do every year in perpetuity.
My question was, so there is definitely a repeating introductory cost which kind of comes in, but also there would be a distribution.
No, there won't be a repeated introductory cost. You know why? Because after year 10, I'm producing exactly the same number of units every year forever. It's only the inflation rate that's kicking in. I'm taking my existing factory, and this capital maintenance is just keeping that factory constantly updated to produce it. And that's why I said if you make the growth rate greater than 1%, then you need more introductory. It's a huge new pain in the neck. because then you got to expand capacity, you got to build a new factory. I don't want to deal with that. And that's why I left it at the inflation rate.
Okay.
You're smiling, so you must have used the 1.5% growth rate for having not built capacity, right?
No, we did reintroductory cost of capex and build
That's
new
fine.
facilities.
That I think is perfectly okay. That then I said at least you were thinking about how much it costs, but you could see how much pain you exposed yourself to by having to do it, because now you got to build a new factory, you got to bring in inflation into that cost, you got a whole new set of depreciation. I don't want to deal with it. So that's why I left the growth rate at the inflation rate. Richard?
So obviously the terminal value for a lot of these projects were huge. Do you think that we're leaving out a significant portion of capex that would be required after year 10?
In what way? I'm not increasing the number of units you're selling. The risk you run is that people stop buying your cars, right? Because that's basically, the problem is not in the capex. It's in that year 11 number that I assume you can keep growing at 1%. What does that mean? Whatever cars you sold in year 11, you're going to continue to sell those cars. But remember, technology is kind of a fickle beast, right? You don't know what people will be driving. Maybe that, I think, is what you're not factoring in when you put in this perpetuity. That's why I left it open to you, because now I was hoping that some of the groups would say, look, this is an electric car. Technology fades. I'm not going to assume forever. I'm going to assume an extra 10 years or an extra 15 years, and then the business is going to fade away. Okay? So it's not that I'm not putting in capex, it's that people will stop buying the product that they're buying right now because the technology changes. House?
For capital maintenance, what is the best way to think about when we're forecasting it? One thing that we did was to think about the reinvestment.
Scale it to depreciation, because
Okay.
and that's what I said, because think of depreciation as depletion of capital. Don't think of it in accounting terms. Think of it as capital being eaten up by what you're doing. Think of capital maintenance as what you're doing to bring back that capital. So if you have capital maintenance equal to depreciation, you're essentially, so it's like calories out, calories in. So if you eat as much as you consume, you're basically going to keep your weight at what it is. So that's, I think, why depreciation becomes a good scaling mechanism to capex. It doesn't always have to be 100%. You could say, I'm going to do only 50% in the first 2 years. But depreciation gives you a good number to kind of look at, say, how much capital maintenance should I be doing in this project if I want to keep it going the way it is.
Okay, so you wouldn't necessarily look at the reinvestment rate and try to cap it at a certain percentage.
But if this were, the reason we bring in reinvestment rates is when you're valuing an entire company, it's a portfolio of projects. It's not one project. This company can take other projects. So that's why we kind of expand the discussion to reinvestment rates. When it's a single project, you can kind of keep it focused. There is, in fact, an implicit reinvestment rate in this project, which in the finite life case, that reinvestment rate was 0. Right? It's actually negative because I was just eating through the cash. In the perpetual life case, it's actually a positive number because I have to grow at least at the inflation rate. So there is an implicit reinvestment rate, but I don't even call it that because it's a single project. Ashwin?
Professor, if we assumed capital maintenance for the finite life case, I understand for year 10, it makes no sense, but for the other years, is that in any way
No, it's not wrong. Here's what I'm looking for. I'm looking to see whether your capital maintenance assumptions are different for the finite life case as opposed to the longer life case. That's what I'll be looking for. So if your capital maintenance is lower in the finite life case than the maintenance case, I'm going to say, okay, that makes sense. I'm not going to contest you on whether the number is too low or too high. It's a judgment call. But what I'm looking at is whether you're treating the two cases differently. So if you have the same capital maintenance numbers in both cases, that's when I have an issue. Say, because you can't, that doesn't make sense to me.
Got it. Okay.
So you think it looks like we're pretty much in consensus, right? I think almost every group said accept the project. If you ask me to hazard a guess, if this were Google and they had these numbers, whether they would take the project, I think it's going to be a very close call. You say, with numbers this good, why wouldn't they? Because they're spoiled. You know why they're spoiled? How does Google make most of its money now? How has it made most of its money through its entire life?
Targeted advertising.
It's a search box. That's it. That search box still is 94% of Google's revenues. Remember about 6 years ago with a lot of fanfare, Google renamed itself Alphabet? And the message we're sending is, look, we're not just in the search business, we're in the home device business, they had all these 6 other businesses. Take a look at what those 6 businesses do for Google every year. And it's like watching Snow White and the 6 Dwarfs. The advertising business is Snow White. It delivers all of the revenues. The 6 Dwarfs are just moochers. They just eat off the table. You know what the return on capital Google earns on its search box businesses? It's like 80%. Now we came up with what, a 12% return on capital on the, which is good, right? 12% is great. If an automobile company was able to come up with a project making 12%, it would be delirious with joy. But if you're Google, you're used to making 80% of your search box, you look at 12%. Now what it looks like to you? It's a terrible investment. Why should we do it? It's a very dangerous place to be, because these, especially very successful technology companies, have a really tough time going into businesses which are capital intensive. Take a look at Apple. I mean, they've been doing this dance with the Apple car. I've seen pictures of the Apple car for the last 8 years drawn by people who've never seen the car. It's not even been made. And every year said, this is the year Apple's going to do it. I am not sure. They might never do it. It's really not their preferred habitat. Google, Facebook, Apple really like to go into businesses that are very capital light, on these huge margins, and this is not that kind of business. And as a technology company, Google knows that technology can fade, how quickly things can change. So even though the numbers look good, will Google do it? It's an open call. In fact, out of the 38 groups that turned in the numbers on this project, 33 said it should be accepted. 5 didn't say you should reject. Actually, 31 said accept, 5 reject, and 2 made conditional statements. I'm going to tell you something. Don't make conditional statements. You know what the conditional statements look like, right? Except if you think the project is going to last 10 years. That's like saying buy life insurance if you think you're going to live less than 60 years. You know, if you know you're going to live less than 60 years, go by, I don't know how long I'll live. You cannot make conditional statements because you either invest or you don't invest. On this, the numbers look good, but whether Google will do it is really going to be whether they can get over their desire to earn 30, 40, 50% returns.
Are you considering the competitive nature of the auto business? Like if you look at Porter's 5 Forces, it's like notoriously a terrible business to get into, the auto industry, isn't it? Because it's overly competitive.
Well, if you play the game, the automobile companies I have been playing, it's been terrible business. The question is whether electric cars are going to be a very different business, and whether this is a business where Google will start with an edge over traditional automobile companies, right? Let's face it, an electric car is going to be more a very expensive electronic device than a traditional car. You still have to build assembly lines, you still have to build the car, frames. But if you take the Tesla, the most expensive part of a Tesla is not the body, it's not the neat stuff, it's a battery and the electrical system that drives the car. So maybe that's the edge you can use in this business. Say, we're not building a traditional automobile company, we're building a very expensive electronics company with that electronics happens to be an electric car. But I think that, as I said, the returns still are going to be 12, 13%. They're not going to be 60, 70%. Sushant?
So I want to know if we didn't discuss opportunity cost in this case, as our group did something.
Tell me what opportunity cost you were. What is the opportunity cost you're worried about?
So I was thinking that in case Google doesn't do GCar, it can still address the software part of the premium automotive market, which might be restricted because now they're only catering to an inside business of GCar.
Now, why can't they do both? You're acting like these are mutually exclusive investments. That's why we have a cost of capital, right? If you bring in other issues now, wouldn't you be double counting?
As in, I was thinking from the case of Apple, it doesn't sell its software because it makes its phone more valuable to have a built system.
Okay, so now we're talking. You're saying instead of making the electric car, what if Google just sold the software to the electric car and it doesn't? You could. I mean, you then have to face a much smaller investment project. In terms of net present value, there's zero chance that the net present value of the software project is going to be higher than the net present value of the car project. But the benefit is you won't have to invest $27 billion up front to do it. So you could do it. I think you can think of, but remember the opportunity cost of tying up capital itself is already captured in the cost of capital. The opportunity cost of not being able to do something else in the electric car business by making the electric car yourself, that's a mutually exclusive project. You have to do everything we talked about in the last class. Any other questions? Okay. Now I want to spend a little, I have only about 15 minutes kind of wrapping up a few last loose ends on the first packet. Now, if you look at where we are, we've looked at how to come up with cash flows and compute net present value, whether it's a standalone project or mutually exclusive projects. And the rule is very simple, right? If the net present value is negative, you should not take the project. And if it's positive, you should take the project. I want to talk a little bit about what we might be missing with traditional net present value analysis. Traditional net present value analysis is static. What do we mean by that? We're stopped at a point in time. We take everything we know at that point in time, we bring it into our cash flows and our discount rate, we come up with the net present value. What it misses are the options that are sometimes embedded that are not captured in the cash flows. Let me explain what I mean by this. When you compute the net present value of a project and it's negative, your reaction is, I shouldn't take the project. That's exactly the right reaction. But if I then asked you, would you be still willing to pay for the rights to this project? Your answer could be very different. You see why? The project has a negative net present value today, but if it's technology, who knows? Technology could shift, and 3 years from now, the project could become a good project. The rights to a bad project can still be worth money because you can delay taking the project. In a future year, the project could become positive. So that's called the option to delay. And sometimes it might mean that you bid on a non-viable technology, even though the net present value of doing something today is negative. The second is you might take a project knowing fully well that the net present value is negative. You're saying, why would I do that? That's crazy. Because it gives you a launching pad to do other things in the future. I like to give the example of a hotel company that opens its first hotel in India or China. And if you just take the net present value of that first hotel, I can almost guarantee you the net present value is going to be negative. Because the first time you're entering the market, you got to build up the infrastructure. And if you just stop there saying, I'm not going to build a hotel, the net present value is negative, here's what you're missing. If you build that hotel and it succeeds, think about the size of these markets. There's an option to expand and build 100 more hotels. That option to expand might lead you to take projects which have negative net present value because of all of those different options that emerge from it. And finally, when you take a project like the Google GCar, what's your biggest concern? You have $22 billion you've invested in this project, right? And if 2 years from now, nobody's buying electric cars, you're kind of stuck. So one of your concerns when you take long-term expensive projects is you're kind of stuck with this project. Wouldn't it be nice if you had the option to walk away from your mistakes, not just in business, but in personal life? If I could somehow build in flexibility where you could walk away from this project if things don't work out, you'd be much more likely to take large projects, even if they have slightly negative net present values, because now I've given you this escape hatch. You know how this could show up? If you have a joint venture with a partner and the partner says, look, if you come in as my partner, in the next 5 years, I'll give you the option to walk away. You'll get a fixed amount of money, less than what you invested, but I put a floor on how much you can lose. It's the option to abandon. I'm not going to talk about the specifics about how to value these options, but the best way to think about any kind of option is in terms of payoff diagrams. Remember in your foundations class, what makes options unique is this kinked cash flow diagram, which is right, which is at the strike price, you get basically your limited losses, potentially unlimited. This is the picture for a call option. You're saying, where does this come in a project? If you think about what you need to invest in a project is the equivalent of the strike price, you will take the project, the present value of the cash flows exceed that initial investment. That's a positive net present value project. But if that's not true, then the amount you lose is fixed because you paid for the rights to this project. So if you pay for the rights to a project, even if it's a negative net present value project, you've essentially bought a call option. It's actually an approach I use to value patents. Because if you think about patents, what you get is the right to do something, but you don't have an obligation. You'd convert the patent into a commercial product if you believe you will make more by converting than what it will cost you to invest. So think of it as buying the rights to a project, which even though they're not viable today, could be viable in the future. What does it mean? Having the exclusive rights to a technology or a product can be valuable even if the product is not viable today. I remember in the early 70s, RCA came up with this product, which was, and I described the product. Some of you might know what it is because many of you might not even be aware of this, but this was this box-like appliance where you put in a tape and a movie played on your TV. The very first VCR was produced at Paramount. In the early 70s, when they did the capital budgeting analysis for this project, they concluded that there would be no demand. And here's why. It was actually true. They said, what would people watch? That display tape we send over and over again, there isn't enough stuff there. So when they did the market share and the market size, they concluded that the project was a negative net present value project, which it was. But then they made a fatal mistake. They said, if the project is a negative net present value project, the rights to it are worth very little. So when Paramount, I'm sorry, when what does I think the first company that came, I think it might have been, it was a Japanese company, I forget which one, approached them and said, it was Panasonic. Panasonic approached them and said, will you sell us the rights to this product? You could see people at RCA laughing behind their hands. They only saw the net present value. We came up with this. These people are crazy. They sold the rights for a song. And the rest, as they say, is history. Panasonic produced the VHS. Sony came up with the Beta. They both exploded in terms of demand. 8 years later, RCA had to go to Panasonic to license the rights to produce VCRs. And what they paid every year was 10 times more than what they'd originally sold the entire rights for. So separate the two things. You can have a non-viable technology. So you might have come with this really creative way of using 5G to do something, but right now nobody has 5G. So when you do the capital budgeting, say, this doesn't make any money for me. But don't make the mistake of just saying, because the net present value is negative, I'll sell the rights to this technology to somebody else for nothing. The rights to something can be worth a lot, even though the project might not be viable today. When we talk about the option to expand, we're talking about something very different. We're talking about a project that has a negative net present value. We all agree it has. But we're doing it because we think it'll give us the right to do something else, which could be potentially very valuable. That's why I use the example of opening a hotel in China or India. In fact, it doesn't even have to be a hotel. When companies expand into emerging markets, especially these large emerging markets, their first investment often will lose the money. It might take the form of an acquisition. They know they're overpaying for this Indian company or Chinese company, but they will do it anyway. Why? Because it gives them an opening to go after this really big market. In fact, when people talk about strategic considerations, isn't this what they're talking about? They say, look, there are strategic considerations for being in China, for being in artificial intelligence, for being in 5G. What they're saying is right now the numbers don't fly, but we need to be in this big market because if we're not in there, we can't do all of this other neat stuff. So what you're talking about is that additional investment you will need to expand. Right now, it might not be viable, but if it does become viable, you could get a huge payoff. So what it effectively also means is you're going to see investments in big markets and as I said, China, India, 5G, AI, whatever the big market is, companies are willing to lose money on the initial investment, have negative net present values because of the option to expand. And finally, there's the option to abandon. These are all called real options. For those of you who heard the word, this is basically what people talk about when they talk about real options, is options embedded in projects. The option to abandon is the option to walk away from a mistake. And basically it means if you have that option, you're far more likely to enter into big investments that require a lot of money because you know if things don't work out, you have a chance to walk away. In fact, during COVID, one of the things I was looking at was what kinds of companies were winners and losers, right? So we found, for instance, that young companies were winning, old companies were losing, tech companies were winning, manufacturing companies were losing. So every week I would take a different slicing of companies to see if I could use that slicing. So I think somewhere in September or October, I decided to break companies down based on flexibility. Some companies are flexible. They can adjust their investing, financing, and dividends much more quickly than others. And in the investment component, companies that have, that have high investment flexibility often have small upfront investments. They can get out of their investments much more quickly, whereas companies which have large manufacturing facilities they've got to build have far less flexibility. And here's what 2020 delivered. It's no surprise. 2020 was very kind to companies with lots of flexibility. If there was a year where flexibility mattered, 2020 kind of brought that home. Kind of, again, intuitive. And in fact, when I broke companies down by decile based on flexibility, this was in the first 6 months of the crisis, or the first few months, you can see the last column. So these are the companies with the lowest flexibility. I measured it based on how much revenues they got per dollar of invested capital. The higher that number, the more flexibility you have as a company. The more flexible companies were, the less they were damaged in the worst months of the crisis. Which leaves me with one final point I want to make. And 2020, again, is a great example of how things can change under your ground. You are a hotel company, you build this huge luxury hotel, it's getting ready to open, it's February 2020. You're very excited, right? You spent hundreds of millions of dollars building this hotel. You did all your research, you did all your homework, you got capital, your net present values are all positive. And then disaster strikes, right? Just as you get ready to open, the world shuts down. Or you're an oil company. You bought those reserves at the end of 2019 when oil price was $75 a barrel. And now it's March of 2020 and oil price at $30 a barrel. So when you look back at this investment, you're probably saying, I wish I hadn't done that. Which is natural. But when you look at projects, there are two things you're looking for. One is you're looking back at past investments to see what kinds of mistakes you made. You'd like to make mistakes where you underestimated things rather than overestimate, but you're looking back at existing investments to see, did they create value for my company? But you're also asking a more dynamic question. Now that we're in March of 2021, what do I do about this project I conceived 2 years ago in a very different world? So on the first one, when you look at an existing investment, let's suppose 2 years ago, you took a 10-year investment. So when you made the original investment, those were the forecasts you made for the next 10 years. It's 2 years in, you're looking at the same investment. You got 2 years of actual numbers, right? And those actual numbers, I can almost guarantee you, will not be equal to your original forecast. One of the things you always worry about in investment analysis is bias, which is people who push for projects tend to push up the cash flows, push up the earnings, make every project look good. One of the reasons you look at past numbers is to get a sense of whether there's that bias. If you consistently find actual numbers coming in below forecasted numbers, you have a bias problem. But in terms of looking forward, now that you're 2 years in, you're going to make some new forecasts for the company, which can be very different from your old forecast. Imagine being Marriott, looking at a hotel that had opened 2 years ago, but looking at that same hotel today. The new forecasts you're making are very different from your original forecast. You're saying, what do I do with this? Basically, with any investment, you're basically going to make your decision on what to do by looking at those new forecasts. So when we look at past investments, it's not for regret, it's not for punishing people, it's to get a sense of, is this just chance or is this bias? Are we doing something which is biased? And if it's biased, you need to fix the system, the way you forecast things. But if it's chance, it is what it is. You can't go back punishing people in 2019 for not seeing COVID coming in 2020. That's really not fair. So I'll leave you with one final page and then we'll end for the day. There are 4 choices you have when you look at a project. And this is an existing project. The first is you can say, we screwed up. You can liquidate the project, get salvage value. You're not going to get what you originally invested back. It's not even close. The second is you can divest the project. Maybe somebody will buy the entire project from you. The third is you can continue the project, even though the cash flows are low, saying this is the best I can do. I use the example of California Adventure. Now I'll end with the story. When Disney built California Adventure, those of you familiar with Disneyland in Anaheim, California Adventure is across the walkway from the old Magic Kingdom. And when they built it, they expected that 70% of the people coming to Magic Kingdom would go across to California Adventure. 2 years in, they realized they had a problem. They realized that only 40% of the people coming to Magic Kingdom were coming to California Adventure because it's a different ticket. It's more expensive. And many of these people had little kids. And the original California Adventure was like an amusement park. It was like Six Flags, lots of rides, and the kids didn't like it. And Disney was faced with a choice. And here were the choices. Obviously, they couldn't divest California Adventure. Can you imagine Disney selling this to Universal? That's not going to happen, right? Divestiture was off the table. You could have liquidated. It used to be parking lots before, but you're not going to get your money back. You could continue doing what you're doing, but it wasn't delivering much in cash flows. So they came up with the fourth alternative. You know what they decided to do about 6-7 years ago? They decided to invest another $1 billion in California Adventure. You're saying, this is crazy. If it's not working, why are you doing it? They built Cars Land and they built Toy Story. I mean, they built all these new parts of California Adventure to appeal to kids. What they were trying to do is get the 40% back up to 70%. So when you look at existing investments, it's not just with remorse or regret. You're doing it asking, what do I do now to deliver the highest value going forward? So next class, we're actually going to start on packet 2. I'll do the last few pieces of California Adventure, not by a couple of pages, but we're going to move into packet 2. So make sure you print off the packet and bring it with you. But next Monday is also the second quiz. So now that the case is behind you, you can look at the second quiz and take an assessment of whether you're ready. But I will see you on Monday.
Thank you.
Welcome.
Professor DeMonaran?
Yes.
The PowerPoint still isn't working for download.
I created it turns out that it's a PowerPoint problem, not a download problem. The PPTX file that I created on the Mac doesn't seem to want to go on the PC. So what I'm going to do is I'm going to replace it with the older version of PowerPoint, which has a different set of prompts, but you can still download it. You can still read the notes, which is why I think people like the PowerPoint slides. So I'll set it up by later today. So you should be able to get the PPT version.
Perfect, thank you. I love printing, so
okay.
I'm a PowerPoint girl. Thank you.
Okay. Dan, your question?
I just wanted to share something funny. Actually, there was a hedge fund manager of a sovereign wealth fund that took your class in the 90s yesterday, and he was an ESG guy, which is kind of funny as well. And then he was complaining about his case that he took with you years ago. He never let it go. So I thought that was funny.
Really? What did he say? That he shouldn't have got the grade that he did?
Something like that. He was like he was talking about capital maintenance or something ridiculous. I think it's funny that this guy
probably this case. He probably held on to that thought still, right?
Randomly. I didn't bring it up. He brought it up to the class randomly.
And then 28 years later.
Yeah, exactly. I was wondering, why do you think Google, like a lot of their hardware stuff doesn't pan out, like Google Stadia or the Google phone? Like, do you think that has an angle?
I'll tell you my theory. Now, what is it that makes young startups succeed? It's being hungry and being desperate, right? You're always in the edge of failing. So what do you have to do? You've got to kind of double down, you got to make sure your bets. So the essence of being a successful startup is you got to be close to the edge, and you got every decision could be a last. So you kind of, you know what all of Google's side businesses have? They have a sugar daddy.
Yeah.
They can take, so I think, and I've written about this before because it's strange, and it's not just Google. It's so difficult for companies that are successful in one business to try to replicate that. I mean, if you look at Microsoft, it took them 30 years to break away from Windows and Office. In 2013, people had given up. They said, this company can never be anything but Windows and Office. Because being successful and being really successful can actually handicap you on these new investments, because those new businesses now have this constant access to capital. So they're not hungry, they're not desperate. They can do stupid things like that Google glasses. Remember that a few years ago? What kind of idiot thought that was a great idea to have glasses where you could, turn to cameras? Did he even think about the fact that, you'd have gyms banning you? And, it was almost like they were doing this. This is neat, engineering. Let's spend another billion. What's another billion? It's a cash cow that will pay us. So I think it's not just Google. It's a lot of companies. In fact, I'd say 95% of companies that try to enter new businesses fail. And maybe we can learn from the 5% that succeeded. What did Apple do in 2000 that allowed Apple Music to kind of explode as kind of this business? Because Apple Music gave birth to the iPod. We forget how much Apple Music was the entry that Apple used to come up with the iPod, which then gave, it opened up this entire device market for them. What did Steve Jobs do with Apple Music, Apple iTunes, the original iTunes, that allowed it to behave like a startup? What did Microsoft do in 2013 that allowed the cloud business to kind of explode and become the successful business? Because that, I think, is where we should be spending our time, because a lot of companies keep trying and they keep failing and they wonder what the problem is. And guess what? They become easy prey for consultants and bankers because they have so much money to spend and they so want to change that they will throw the money at the wall. Oil companies trying to become green energy companies. How many have succeeded? And this is, I think, it goes to the core of the problem, which is it just requires a mindset that they might not be bringing to these new businesses.
Okay, thank you so much. I just wanted to share that with you. Have a great day.
You're welcome.